What is going on, everyone? Welcome back to the Retire Ready podcast. My name is Kolin. I'm here with Kyle. Kyle, how you doing today?
Great. About 100 and some degrees out here, so I know everyone's feeling the heat wherever you're at. Looking forward to going through today's podcast episode, talking about a lot about like Roth conversion misconceptions. Other than that, I celebrated my 36th birthday on Father's Day, so that was fun. Spent some time with the kids, and now kind of 4th of July is kind of around the corner, so I know everyone has their own special events they like to do on the 4th of July.
Yeah. So without further ado, let's just jump right into it. So, like Kyle said, we're going to talk about 9 Roth conversion misconceptions, things that people think one thing about them, but that's not necessarily true. So let's just jump right into it. So the first one, Kyle, is that Roth IRAs are better than IRAs because I pay my taxes now, I don't pay later. But maybe why is that a misconception?
Yeah, I think there's a lot of like obviously the Roth IRAs and Roth conversions have been pretty popular the last, I would say 5 years have probably come back into like the financial advisor world. But at the end of the day, if you just kind of strip away some variables and Roth IRAs, they're not better than IRAs. From a mathematical perspective, really what you're deciding is do you want to pay tax now or do you want to pay tax later? Deferring those taxes till later, it all comes down to your specific situation and your household situation. But if tax brackets, or if like your household tax bracket as it is right now stayed the same forever, the Roth IRA versus the traditional IRA is equal. So if we just kept basically said if everything stayed the same, those dollars, those account values are ownership wise, those are equal. Your tax bill would be the exact same now versus later. So there is one misconception there, but again, like very rarely is someone's, tax bracket or their effective tax rate working the exact same as it is in retirement, but sometimes it is. But if you kind of just take away some of those, misconceptions or variables out there, dollar for dollar, they are worth, they are the same thing. So.
Yeah. And then the second misconception here is like you just mentioned, Roth conversions have gotten a little bit more popular. And someone might just say, well, okay, I'm going to do a Roth conversion. I'll just convert whatever. I'll just throw 100,000 in a conversion because that's just, I want to do a Roth conversion. Why is like the whole, just convert anything maybe a misconception?
Yeah, so I'm a very big believer in this, like just winging it from a tax planning perspective and not taking like a comprehensive approach. That could actually potentially lead you to overpaying in taxes. So no plan is from tax perspective is not a great idea. Just convert anything or hey, just max out your Roth 401k because you can. At the end of the day, you have to do some planning here. So you have to basically come down to the fact of like what's your effective tax rates now, what are your effective tax rates going to be early in retirement, and then like a really good strategy would be like go and look at some required minimum distribution projections if you didn't do Roth conversions, with your Social Security and other sources of income, and like what's your effective tax rate when you're 73? What's that number look like? Are there any strategies that could potentially lower your effective tax rate so that your RMDs don't bump you up? But just like, hey, I'm just going to do a $50,000 Roth conversion because it sounds like a great idea. I did one in when COVID happened, right? I did a Roth conversion and it worked out. But the idea is like usually the tax execution is more than just like winging it. It's usually like a 3, 4, 5, 6, 7 year strategy where like you got to do a certain amount over tax free to lower that average or effective tax rate long term. So I got an example here. So if I've been a married couple here, let's just say they're in 2024, married couple. Let's just say their taxable wages are $184,624, and they're going to take the standard deductions. Well, if I go in here and look at their tax report or their scenario, they're in the 22% marginal bracket, and their average tax rate on all those dollars is 13.2. So if they just winged it and just did like 30,000, 40,000, they don't really know. But at the end of the day, if I just said, all right, I read an article and it said fill up your current tax bracket because like when I talk to people, even when we do our retirement master classes, like we give people homework and we say, how much room do you have in your current tax bracket? That doesn't mean that's the plan. I'm just wanting people to do some homework and get educated. Like this household here, they have like $45,500 of room before their effective tax rate would change. Does that mean they should do 45,500? I don't know. That's a pretty even number. For their plan, they might have to do $73,400 or go up to IRMA. The idea is there's more than just looking at a concrete number and just winging it and saying, hey, at least I did something, because that could accidentally lead you to like overpaying in taxes long
Yeah.
term. Because there's not going to be enough in your Roth in the future to make a difference on your tax bill.
Yeah. And then, with that being said, Roth IRA, tax free, everyone loves that stuff. But, some people might say, okay, I want to, for my heirs, for those that are going to get this money after I die, why not just get it all tax free for those, for my children or whoever my dependents are, they're going to get that money. Like, why is trying to be all tax free maybe a misconception?
Yeah, so we have to come thinking about the value here. So, like if your goal is like leave a bunch of tax-free money behind for your beneficiaries, have you ever heard of life insurance? Because that's a great way to pay a little, some principal or pay some premiums each month to buy a large amount of tax-free income. So that's something to consider. But being all tax-free to your beneficiaries, like future generations, like should play a factor in your tax plan. But I don't know that should be a driving force, because I get, maybe not for some people, but my discussions that I have and the clients that I work with and the people that I talk to is their main focus is not to leave as much money behind for their beneficiaries. Like they might have goals of what they're trying to leave behind, but they're trying to plan for their own retirement first. Like, hey, it's kind of like the airplane reference. Like, hey, put your own mask on first before you start planning for somebody else. Their main goal is like, how do we maximize our spending early in retirement? How do we create better tax diversification? Not really saying, hey, I want to leave a bunch of money tax free to my beneficiaries. That could be part of the plan, but like you might slowly execute that to leave them some tax free income where like they can inherit that Roth for 10 years and then leave it in there. But again, another great way to do that would just be life insurance. Like take a little bit out from your tax deferred accounts each year to buy life insurance if that's truly what you want to do. So.
Yeah. Another misconception that people have about Roth conversions is doing a Roth conversion then prevents you from contributing to a Roth IRA, right? Like that counts towards your contributions for the year. Why is that a misconception?
Yeah, that's a misconception because a Roth conversion does not count against your modified gross income when we look at like income tiers and qualifications. So for like a Roth IRA, that household I gave you that example of, 184,624, that was like their taxable wages. That IRA for a married couple in 2024, that contribution rate is between 230 and 240. There's limits and phase outs. So if they did a Roth conversion and it bumped them over the 230, they'd still be under the qualifications to technically make an $8,000 contribution each into their Roth IRAs. Now, would we do that? From my perspective, like maybe not. Typically, I'm just going to give an example here. So let's just say your whole working career, everything you've saved has been in your traditional 401k, your pre-tax 401k. You have no money in your Roths. For us to max out Roth IRA contributions might not make sense. That goes back to just doing something like, hey, I did a Roth conversion or I funded a Roth contribution, because instead of taking 16,000 and funding it into Roth IRAs, you might say, all right, let's do $80,000 Roth conversion and then use that $16,000 to pay the tax bill. And I know one of the misconceptions we're going to talk about is how to pay the tax bill, but just understand, like, if you do a Roth conversion at any point in your life, it does not go against your modified adjusted gross income.
Yeah. And then moving into another misconception here is, a conversion only makes sense if I pay that tax bill from my savings. But why is that a misconception?
Yeah, it's definitely, it is okay to pay taxes out of the conversion. Like obviously your first priority would be, is there another bucket of money somewhere that you can use to pay the taxes from? Because then you're moving more money over to your tax-free bucket. But again, if you understand like Roth IRAs versus traditional IRAs, like if tax rates are the same, they're worth the same. So a misconception is like don't do Roth conversions if you don't have a taxable bucket or a savings bucket to pay the tax bill from, because you can definitely pay the taxes from uh, on the conversion.
Yeah. Moving on to number 6 here, misconception may be that I'll just pay my conversion taxes next April, next tax year. But why is that a misconception?
I mean, you can, depending on the IRS, they might hit you with the underpayment penalty. But so there's a couple ways you can do if you're withholding the taxes from the conversion, obviously it's going to be paid right away. If you're going to, let's say, do a $100,000 Roth conversion, you owe $22,000 in federal taxes and state. Let's just make it easy. If you're going to pay that money from maybe like an outside source, like a money market, checking, savings, or a taxable brokerage account, I would definitely, it would probably definitely make sense to make estimated quarterly payments on that tax bill. But one strategy is if you're going to if you're going to pay the taxes from the conversion, what you could do is if you're going to do a $100,000 Roth conversion and you owe 22,000, what you could do is move over 78,000 in a conversion and withhold no taxes, and then send $22,000 in federal and state taxes in December as a distribution from your IRA, and then 100% of that just goes towards Uncle Sam and the state. So you could get away with that strategy and pay the taxes in December versus waiting till April. So then that way you have more shares invested for a longer period of time.
Yeah. Another misconception may be that people, they read about a Roth conversion and they're like, all right, I'm gonna do where I fill up my tax bracket, right, this marginal bracket, or I might bump into the next one, but I'm just gonna go with just this one because there's only one way to do it. But why is believing that there's just one way to do a Roth conversion a misconception?
Yeah, so there's a bunch of ways you can lay out a tax plan. For some people, like doing Roth conversions doesn't make sense at all. It really comes down to like what you're spending, what's your lifestyle going to be, what are your goals, when are you taking Social Security, are you married, are you single, is there an age gap? But just like narrowing in on one strategy, there's really more to the planning behind that. You have to kind of look at short term and long term, and then work yourself backwards. Like, hey, do I understand how provisional income works? Do I understand that Roth IRA income doesn't make my Social Security taxable? Am I aware of IRMA limits and it might bump up my Medicare premiums for a handful of years? What's my age? How much cash do we have? Do we have brokerage accounts? So just narrowing in on one decision doesn't really make any sense because you have to create flexibility. I think one of the ones we talked about in a past show and podcast was like market timing Roth conversions, which is a really good one. You might have a goal in place that you need to move $60,500 every single year or something. But if the markets were to, pull back, when they pull back, you maybe you go and double that up or something. So that, there's just not one goal. There's markets. You have to kind of play into factors, your lifestyle, your time horizon, everything.
Yeah. And with that, kind of similar to one we talked about earlier, but a little bit different, misconception may be that, my goal is just, convert everything because I want to pay no taxes. A tax-free retirement is the best way to be retired. Why is that a misconception?
Definitely a misconception. It's a sales pitch. Chasing a tax-free bracket, it definitely, I give people examples of like how that could work. And it is optimal for some households. It really depends on how much you have saved and how much you're going to spend. But a tax-free, like chasing a 0% tax-free retirement for a majority of individuals is probably suboptimal because you're really leaving, you might be paying too much in taxes or, selling too many shares to get to a tax-free income retirement. It might actually, we don't have that crystal ball on how long you're going to be here. So we kind of have to try to do a balancing act of, tax planning and like how much tax-free income do you really need? From my experience, like when we do the planning, we just like to create tax diversification and having like, we just like to be ready. So like when taxes go up, we're ready. We've done this. If markets go down for 2 to 3 years, we're ready. We'll sell these shares. In retirement, when you need an extra $25,000 for this event, you have this bucket of money to pull it out. If you're married and one spouse passes, you have tax-free income to come in for the surviving spouse. So it's really like chasing tax-free is not the idea, but like properly building in tax-free and tax planning strategies to your plan to say, hey, I do this, this, and this for 6 years. It's going to allow us to keep an extra 50% of our Social Security. That stuff makes sense, but just like chasing tax-free income might not make sense because you still have like standard deductions. Like getting everything over to Roth IRAs doesn't make sense because you still want to be able to offset your tax-deferred income with standard deductions. So,
yeah. And then the ninth and final misconception about Roth conversion is that, quote unquote, I need to be done with my conversions before my RMDs kick in. Why is that a misconception?
Yeah, it's not true. I mean, you cannot convert your required minimum distribution. So, like, let's say a required minimum distribution is coming in, but you don't need it. Really, the only place you can reinvest that is into a taxable brokerage account. But any dollars after your Roth conversion, after your RMD, you can convert those. But there's no timetable because everybody's situation is different on like when they should do their Roth conversions, because at the end of the day, it kind of comes down to math, logic, and some emotion, and like what are you trying to accomplish from a planning perspective. So no, I've had plenty of discussions, built plans, have clients that do Roth conversions after their required minimum distribution because they're going to keep doing them after their RMDs, so it lowers their future RMDs. Because there's no required minimum distributions on your Roth IRAs. So they're going to continue to do those so it lowers the future required minimum distributions.
Yeah. So Kyle, any other, words of advice or things that you've heard of in your practice about, misconceptions about Roth conversions, or any lasting words?
I would just keep an open mind. Don't just execute it. Don't like nakedly just do something or blindly, do a tax strategy. Like there's definitely a well thought out plan. Like look at the pros and the cons, and then look at all the available options that are available for tax strategies, and like which of those are you going to start to execute to like start creating like a tax plan that fits your household.
Awesome. Well, there you have it. There's 9 misconceptions about Roth conversions. Thank you all for listening, and we'll see you in the next episode.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. The word retirement shouldn't scare you. Our passion is to be here to help you navigate every step of the way. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon. But in the meantime, for more education and information, hit up retirereadyacademy.org. And if you're ready to start your retirement planning today, go to our website at mocanwealth.com. Mocan Wealth Management is a registered investment advisor with the state of Kansas and Missouri and may only transact business with residents of those states or residents of other states where otherwise legally permitted, subject to exemption or exclusion from registration requirements. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services.